Hello sector watchers, it is the last Tuesday of the month and that means that it is time to look at seasonality. In this show we will look at the theoretical expectations based on historical seasonality and see whether we can align that with the actual sector rotation as it is playing out at the moment. And I will explain why I think that the current renewed rotation to defensive sectors could bring the S&P down to the area between 3900 and 3950. This is the 132nd episode of Sector Spotlight for Tuesday, the 30th of August. I'm recording it on Monday the 29th. My name is Julius the Kempenaer and I am presenting to you from Amsterdam in the Netherlands. Ladies and gentlemen, this is Sector Spotlight. Let's kick off with a look at the seasonal performances for the various sectors. We start with a 3D graph of the outperformance for every sector per month. So this chart shows you the number of the percentage of months in which a specific sector outperformed the S&P over the last 20 years. And if we go through the column of September, then we see a few kind of interesting things. The first one, very clearly, the strongest signal is for the industrial sector. The XLRE outperformed the S&P 500 70% of the time over the last 20 years. That's a reasonable number. That's something that I want to investigate. There are two other sectors which are at 60%, and that is energy and that is consumer discretionary. It's not the best. I mean, it's very close to 50, which is the toss of a coin, so not that reliable. So I like the 70% much more, obviously. And on the downside, we have the lowest ranked sector is utilities, XLU. XLU outperformed the S&P 500 35% of the time over the last 20 years. That means that 65% of the time XLU underperformed the S&P 500. That's obviously also interesting information. And then there's two others, that is materials, which is at 40%, so 60% of the time underperforming. And that is that's what it is, and it's not even fantastic, especially not when you bring in the percentage outperformance, the price outperformance over the S&P 500. So if you look at those sectors, then maybe even materials XLB is the most interesting one with minus 90 basis points, where that sector underperformed 60% of the time. So that is, it's interesting enough to take a look at. Let me put it like that. Industrials with 70% of the time outperformance only outperformed 0.4%, so 40 basis points over the last 20 years. Interesting enough. And then we have utilities, which was at 35% with 0%, so that's moving in line with the index basically. And consumer discretionary is at 0.3% outperformance. So what does that mean in terms of sector rotation? Because in a minute we're going to look at the sectors and the sector rotation, and we're going to try to blend in the information that we just got from the seasonal patterns and see if we can match that or maybe negate with what we see in the actual rotation on the chart. So what we're looking at right here is the theory, and when we bring in the relative rotation graphs with the actual rotation, that is reality. And what we're going to try to do is see if we can match a theoretical outlook with reality that is currently playing out on the screen. A quick look at the sector rotation as it played out last week, and as it's currently playing out on the daily and the weekly RRGs. learns that there is definitely again a rotation to defensive sectors going on. We discussed that last week already, and we were pointing to the tail of utility that started to move up, staples that didn't fall further, and basically healthcare is the only defensive sector that is still at a more or less negative RRG heading, but all of them are still on the right hand side of the graph. Also, energy has now completely turned back up and is now again, albeit just, at a strong RRG heading between 0 and 90 degrees. So it's now on its way back to the leading quadrant, basically picking up its leading role again. And if we look at the more offensive sectors, then we can see that technology, it did enter the leading quadrant, but it almost immediately started to lose relative momentum. And we see that consumer discretionary, XLY, which is here inside the improving quadrant, but already starting to lose relative momentum. Very clearly, the communication services sector is the sector that is now turning back down. Wrote an extensive blog article about that last Friday. Basically, I think that is the worst sector in the S&P right now. Just simply underweighting your communication services holdings will already give you an edge over the S&P 500 by just not being invested in that sector. If we bring in the dailies, that's what happened over the last 5 days, then it is very, very clear that the rotation to defense is underway. Because here you see utilities powering into the leading quadrant, you see staples powering into the leading quadrant, and you see that healthcare is already picking up and trailing the XLP sector, the consumer staples sector. Also here, communication services sector rotating back down. So as I pointed out in that blog article last Friday, communication services both on the daily and on the weekly RRG, tails are rotating back down into the lagging quadrant, both after a rotation through improving without being able to hit the leading quadrant. So that is basically a double whammy in terms of bad rotation. Technology on the daily already hitting the lagging quadrant again, real estate moving back down, and we see that consumer discretionary is inside weakening and heading towards lagging. So the rotation to defense on the daily RRG very, very clearly visible. And I think that also is becoming clear now in the chart of the S&P 500, which got pretty bruised over the last couple of days, maybe even a couple of last week, I have to say. So if we bring in that chart, then here is the chart of SPY. And I magnified it a little bit to zoom in on the latter part. And I think with a little bit of fantasy, or maybe you don't need any fantasy at all, we can see a completed head and shoulders pattern here, a small completed head and shoulders pattern, which formed its peak against that falling trend line. That this connects the previous two, and it now connects 3 peaks, and then it becomes a serious trend line. So before 431.7 was put into place, this line had no meaning whatsoever. But right now, because we now have 3 touch points on that line, now it becomes a serious level that we have to take into account. And it's very close to that previous high at, let's say, 428, 430. So that 430 level was and is an important level for the S&P 500. So we moved up, we peaked at 431.7 and came down. We put in a new low, rallied, kind of closed the gap here, but not quite, because the low of the gap here is 421.22 and the highest point here is 419.96. Basically, the translation in terms of supply and demand is that the sellers did not even want to wait until the gap was closed before they came in with new supply, and the buyers were not willing to pay up for that new supply. That's why that low came in lower. And then last Friday, we had a very bad day and we broke that trend line, that neckline, which connects the 2 armpits of that head and shoulders pattern, which is now completed. And today has a pretty good follow through going lower. If we go with the assumption that this head and shoulders is in play, then I'm going to do it very roughly. We got 430 at the peak, we got 410 at the neckline, that's 20 points, and then the break is 412, 410, so that gives us a price target based on this head and shoulders pattern, 390, 392, which coincides with the support level that we have, 1, 2 peaks, and after the break, 1 low. So near term, the next level that I'm watching for the S&P 500 is around 390 based on this head and shoulders pattern, following the weakness in rotation in the various sectors. Okay, if we move on to individual sectors and try to align them with the seasonal patterns that we just described. I think here's the weekly chart of the S&P 500, which is just a bigger picture chart, shows you the same thing, not as detailed, because here this is a head and shoulders pattern that we just saw on the daily chart. It's not even visible on the weekly, so small it is, but still it gives us good information for the next couple of weeks, I would say. Onto the materials sector. The materials sector had 40% of the months in outperformance, which means 60% of the time underperforming the S&P 500, and the average return was minus 90 basis points. And if we look at this chart here, then I hope you agree with me that this is definitely a negative chart. We broke out of that small rising, well, is it a trading range or was it a trend? Maybe something in between. But the break was very clear, and now a couple of weeks ago I had a sector spotlight show which was titled Sectors Are Kissing Resistance, and this was one of them. This is one of those situations where sectors broke down, rallied, and now they are kissing former support levels that are now acting as resistance, and materials sector is a prime example of that happening. And you see that the relative strength came down, moved sideways, and is now pushing against this horizontal level, which has been in play basically for almost 2 years already, and the sector is deep inside the lagging quadrant. So that 40%, so 60% chance of underperformance with minus 90 basis points makes sense to me. Based on this combination of information, the theoretical underperformance expected and what we see in reality kind of makes sense. So I'm going to expect the materials sector in the coming month to underperform the S&P 500. By how much? 90 bips. If you want to multiply percentage with returns, then we would have to do 0.6 times minus 0.9, so that is, let's say, maybe 50 basis points underperformance for the materials sector in the month of September. The other sector on the other side was industrials, and industrials, the odds were 70%, or historically 70% of the time the industrial sector outperformed the S&P 500, and the expected return was 0.4, which is not much. If we look at the chart on reality again, let me highlight that XLI tail for you, then you can see that this tail actually rotated through weakening and is now coming back and just crossing over into the leading quadrant again, which is positive from a relative point of view. If we translate that to the price chart and the relative chart on the right hand side, I think the price is still captured in a broad trading range. This old high here, early 2020, with the levels here around 82.5 is definitely still in play. And then we've got 105 on the upside, which is clearly a very important level. And then we had this 97.5, which was, well, not really the middle of the range, but it's a level that the market respected here. And now we peaked above it and we're sort of playing around with it. It doesn't make a lot of sense anymore right here, coming down a little bit. But what's more important is that the relative strength is breaking to new highs or breaking out of its range, and that is important because we're looking at the relative performance of the industrial sector versus the S&P 500. As I said, 70% of the time this sector in September outperformed the S&P 500 and it looks as if it's going to do that again. This upward break out of range in relative strength is underscoring, is confirming the strong rotation that we see on the RRG, the tail moving back into the leading quadrant, and the expectation for a strong rotation of the industrial sector into the month of September. So I think those two are probably the most noteworthy rotations where theory and reality are more or less matching. That means that we're going to see an expected underperformance for the material sector, and we're going to see an expected outperformance for the industrial sector. What does it mean for the other sectors? What is going on there? If we look at communication services, as I said, probably the worst sector in the S&P 500 right now. Look at that tail rotating back into the lagging quadrants from improving. And if you look at the trend here, then this is today, this is the first trading day, it's a weekly chart, so this bar here is only Monday, and you see that we're leaving this upward angling consolidation within the downtrend, so I'm going to expect an acceleration lower for the communication services sector in coming weeks, and that is more than confirmed by weak relative strength, which is pushing to new lows almost every week. If we look at energy, that finally seems to be ending its pause in the rally. Obviously, we had that massive rally since 2020 and then the acceleration to levels above 90. And then obviously, when you have a big rally, you can expect a big drop. And we tested the former resistance as support. Again, a very good example of old resistance turning into support. And we're now rallying off that former resistance level, now acting as support, starting to move higher. And finally, relative strength is starting to pick up as well. And you can see that magnified in the RRG, where the XLRE tail is now starting to point upward and moving back towards the leading quadrant. Financials, again, talking about kissing resistance. You see the financial sector broke away from this toppish sideways consolidation, found support at the level of the peaks of 2020, rallied, and it now formed a new peak, found resistance at the level of the May high, which coincided with the falling resistance line that runs over the peaks that started at the start of the year. And you can now see that we're sort of playing around with that horizontal level in relative strength, and it positions the financial sector close to the benchmark, short tail, just moving into the improving quadrant. But look at the daily tail. Where's the daily for financials? Here it's inside leading, but it already started to rotate back down. So with this rotation on the daily, I am not convinced. As a matter of fact, I'm quite unsure whether that weekly tail will be able to pull all the way through. I think the odds are more for financials to either stay here or roll back down, back towards the lagging quadrant. Not a very good rotation for the financial sector at the moment. Here's technology. We tried. This is very much in line with the chart of the S&P 500. And you see that technology took out its previous high, came out of the falling trend channel, but so far not being able to pull through. So we now have the first move lower. And that's going to be interesting. I'm watching support around 134 here. That's the previous high that we saw here in June. I mean, if I just think out loud forward, then it would be very strong if we could get a new low in place, ideally around 134. and then start moving back up, because that would mean that we have higher highs, higher lows in place. At the moment, that's not the case yet. It's going to be very crucial where that new low will be formed. What is a little bit more worrisome is the loss of relative strength, because we had that try up and now we're declining, and you see that both RRG lines are rolling over, and it's already translating in a loss of relative momentum here on the RRG for the XLK tail. So keep an eye on technology, but for the time being, I would say be pretty careful, because on the daily RRG it's already moving towards the lagging quadrant again. So even if this is playing out as the bullish picture as I just tried to describe, it's not going to happen in the next few days. We will see more price action and we will see a low forming. I don't expect a V spike here, let me put it like that. Here's staples. Again, talking about sectors kissing resistance. Here's that old rising support line, breaking lower, rallying, and kissing that old support line that's acting as resistance from the downside and now coming down again. Relative strength's picking up, not quite there yet. The good news is that it is still on the right-hand side of the graph, so there is still a bit of room. The loss of momentum is gone. So that loss of momentum that you saw here, that's why that green RS momentum line is now moving flat. So that danger is gone, and what we now need is more upside relative strength, which will pull the green RS momentum line back up, and it will turn the XLP tail back up towards the leading quadrant. The only thing is, it's a defensive sector, and it's not good news for the market when utilities are rotating back to the leading quadrant together with staples and healthcare. So here is real estate, another one kissing resistance. Here's this old head and shoulders. We already reached the target. Then we rallied, so that old neckline is now starting to act as resistance, and we're coming down. It's going to be interesting to see whether this rising support line in relative strength is going to be able to hold up. If you look at the tail, then it's very close to the benchmark, and it's just started to move back further into the lagging quadrant. So not a lot of strength expected for the real estate sector either. And then we have utilities, as I said, the only sector that not last week, but the week before pushed to new all-time highs, and we're holding up quite nicely. If you look at where we are now, this old high here, which is just a little bit below the all-time high, that's around 75, is now acting as support. Relative strength is picking up again, and if we look at the utilities tail, then you can see that that tail is the highest reading on the RS ratio scale. That's very important. It's the strongest sector in terms of RS ratio, and it's now again starting to pick up relative momentum, which is good news, especially when relative strength here can push beyond this previous high of 27th of June. If it takes out the all-time high in price, then utilities are definitely the leading sector. But again, staples, utilities in strong trends, relatively speaking, is usually not very good news for the market as a whole. Then we have healthcare. Relative strength is holding up above the breakout level. Healthcare is the weakest of the defensive sectors. So all three defensive sectors are doing pretty well, but utilities and staples, they're doing really well, and healthcare is on the back burner. It's lagging the other two. That can change. For sure that can change. If you look at the daily RRG, then you already saw that healthcare was starting to pick up inside the improving quadrant. So you definitely cannot rule it out yet. But on the price chart, I think we would like to see a penetration of 134 to the upside, which would open up all the way to 140 and possibly higher. It will also actually pick up in terms of relative strength when that happens. And looking at the position of the XLV tail inside the weakening quadrant, there is still quite some room to maneuver and to make that turn back up. And then finally, we've got consumer discretionary. Again, kissing resistance 2 weeks ago, peaked just intra-week. We peaked above that falling trend line. We closed against it, and we're now moving lower. And look what's happening in terms of relative strength. We broke below that horizontal level and we're now kissing that level from the bottom here, and it's now starting to act as resistance in terms of relative strength. And if you look at the rotation on the RRG, then you can see that it is moving towards leading, but it has already started to lose relative momentum. So the question is whether this tail will actually hit the leading quadrant, and if it does, if it doesn't start to move immediately down and not really power into the leading quadrant. So with this type of new peak into place, consumer discretionary is not in a good position for outperformance in the next couple of weeks. And that concludes Sector Spotlight for this week. Thank you for watching. Please remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. You can watch the show on YouTube or via StockCharts television or any of the on-demand channels. I'm looking forward to seeing you again next week, same time, same place, for a new episode of Sector Spotlight.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.